Let's connect then with Mehul Bhatt. He is the founder and chief investment officer at OysterRock Capital, right here in our studios. Thank you so much for taking time out and joining in. We were talking about how the color of the day is clearly red, but despite that, you seem to be optimistic. Why is that?
Thanks for having me. I think two things at work here. One was that in the last few months, especially, markets have been quite expensive, and you had lots of companies that we had shortlisted but not getting the right price to buy at. I think that's changing now as we speak. And the second is, if you speak to people in corporate India, a lot of ideas around acquisitions or capex seem to be muted now. I think that also gives us hope that the returns in these underlying businesses will actually improve, and that in turn will produce better returns for investors like ourselves. So if you look 2, 3, 5 years out, which we tend to do, and we look for these anomalies in the market or idiosyncrasies where you can capture value. I think a lot more are emerging now than what we saw even a month ago or even 6 months back, and it just improves the odds for people like ourselves to actually invest.
The fair point taken, and you do invest in special situation kind of stocks, the
Right.
ones where value is, mispriced at the moment. Let's put it like that. Which give us some instances or give us some of the stocks wherein you are seeing value, because right now, I think in the last 10 days itself, we have heard about many management changes, right from TCS, Tech Mahindra, HUL, and the list really goes on with ICICI Pru, etc. as well. Spot some names for us.
So I can't talk about individual names for compliance reasons, but if you look at financials, for example, what we've seen in the last 3 quarters, we've seen very good growth. So 3 years back, if you asked any of us, would either private or public sector financials see a 17% ROE in 2022 December, we would all have disagreed with you vehemently, and here we are. So, I think growth may be a little tepid compared to the first 9 months, but that pocket looks pretty interesting, and you have a lot of options to pick and choose from. So there are banks which specialize in SME. There are some that specialize in lending to a particular set of people. So you have a vast range of options to pick and choose from, and that seemed like an interesting pocket to hunt in depending on your preferences. The only issue or a little bit of a challenge is that there's probably a consensus that most people talk about financial investments, and I think you don't necessarily need to be contrarian all the time to actually make money. So I think that pocket looks interesting. Many of the infrastructure, though we don't really buy those names, but the allied sectors within that supply to infrastructure, so firms that make pumps, valves, tools, a lot of them look pretty interesting with the underlying capex story that's emerging. While the larger names in the capital goods space look expensive, there are many opportunities now, especially in the context of what's happened in the last few days, that look pretty interesting to us actually.
Okay. And as another theme that you guys look at in terms of finding value is a lot of these businesses in spin-offs and transition. What's the rationale for that?
So we've seen, and I think there's a lot of work done, and the famous investor and author Joel Greenblatt also has done a lot of work on that. And these tend to create a lot of value as soon as one company spins off 2 or 3 businesses, each one gets listed separately. We've had so many instances in India in the past few years more so, where a business had some industrial, some consumer, and some B2B, where the consumer was spun off. They get a private equity guy in, runs it as a separate listed entity, and we've seen the underlying engine play out much better than when it was a part of a conglomerate business. So we feel pretty excited by those opportunities, and even as we speak, there are a few that are emerging which eventually will get spun off, and those tend to be low-hanging fruits for guys like us who look for these anomalies and these idiosyncrasies.
But it's a very something that you have to be a lot patient about, because for instance, for Reliance, we have been talking about the spin-off happening. It's been what, 2 to 3 years that it hasn't taken shape. Similarly with ITC, it's been much talked about. The hotel division will be spun off, but you don't know when that will happen. But in any case, I want to come back to the point that you were talking about the financial space and PSU versus private. PSUs, apart from this year wherein it hasn't been that great for them, over the last couple of years, they've returned what, 60-70% already?
Yes.
Still a buyer, and not just the key name of SBI, but the the other smaller ones
Yeah,
too?
sure. I think a lot of them look pretty interesting because each one has a niche of its own. So someone specializes in, lending to truck, to CVs. Someone specializes in some other area of lending. So the gamut is pretty vast, and wherever one feels comfort about the opportunities that exist, I think whether it's a small finance bank or the smaller private banks. Or the larger public or private banks, I think the opportunities across the spectrum in that space.
Okay, fair enough. What is it that you would advise investors to do then to hunt for those long-term compounders at a time like this? Like you said, there's still that silver lining despite the volatility that we're seeing. So what should be the approach right now?
So I think there are
because there is that nervousness in the market.
Sure, but there are different ways to bell the cat, right? I mean, it depends on your temperament. So what we do best is buy for a 3 to 5 year horizon and wait for these businesses to actually emerge or flower. And I think volatility is actually a friend for people like us who are looking for these opportunities. So, I mean, thinking about it, actually, such markets give you much better options as an investor as opposed to, bull markets where it's much harder and everything's going up every day. So our belief is that people who have a 3 to 5 year view, this is, I think, a much better time than any to actually, start, if you've not already started, to increase your investments in especially names where you've done enough work, you've been waiting for the right price, and here you have those in many instances. At least this is a great start to our minds, for sure.
You're not helping us by giving us the names of those stocks, but at least tell us which is the area which is a complete no-go at the moment, which seems, let's say, bloated, inflated, or as you said, maybe much talked about consensus, etc., something which you wouldn't even touch with a long pole.
So you got to get approval from our compliance people for me to give you names, but
we always try our luck, don't we?
Sure.
But it's our job. We've got you here.
Sure. But I think interest rate sensitive businesses, whether it's in consumer discretionary or classic would be a real estate and allied businesses, are places where I think it'll take a little longer. So corporates, when we speak to them, interest rates exactly 12 months back in the US were 1%. Today they are 5 or 6%. And this is actual interest payouts by companies in India also. In India also, housing loans have gone up from 6.7, 6.8 to 9 plus today. And that's the case in the industry also. So I think that's a place where you're going to find it hard for companies to grow. Or to actually be able to defend their profitability. And we'll see a little bit of consumers also delaying decisions, especially in purchase of houses or in purchase of large ticket items where they're dependent on debt.
So discretionary might take a hit in terms of at least a very long, big ticket item, and the likes of real estate, etc., might come under pressure. Thank you, Mehul, for joining us today. Appreciate you being with us in the studio here. But